Hey everyone, welcome back to the Velocity channel. This is CJ and I just want to let you know that this is your bridge to financial freedom. Listen, why is it that people ask the question, CJ, why would you want to use credit cards and credit lines to pay off loans? Why can't you just use your checking account or even your savings account? Why? And those are good questions, right? That's a great question. And my answer is this: because it's easier to create $10,000 than it is to save $10,000. And I'm going to say that again and prove it. It's easier to create $10,000 than it is to save $10,000. Do you want the proof? Look in the mirror. Right? Listen, whether you're creating that through a good credit rating, right? You got great credit scores because you've known how to pay certain credit cards and loans, or whether you're in business or even you're a real estate investor, right? You already know that this is true. Now, the reason why you want to use it is because it's other people's money and it's a good habit to be in, especially if you're responsible, because guess what happens? See, with money, it's more than money. With other people's money, it's more than money. It's a relationship. What happens when you are responsible with other people's money? Will they want to give you more? That's usually how it works, right? Absolutely. So they want to give you more and more and more. And the answer is because more. We want to be good managers, good stewards of the finances that we have so that we can have more, and then we can use that more to create even more for our community, for our family, and everything that goes along with that. So listen, that's why you don't have to, right? If you want to save for months on end, the $10,000, feel free. That's good, all right? And I'm happy for you. If you want to almost starve yourself in doing it, get 2 or 3 jobs, that's cool too. However, when the people's money is there, we want to be good stewards of it so that we can have more. Because you know what, the one thing that a bank will never do? It'll never reward you for saving $10,000. It'll never say, you know what? You did a great job saving this month. Here's an extra $1,000. Here's an extra $2,000. You know what? We're going to go ahead and give you a savings limit increase of $3,000. The bank will never do that. It's not in their model. But the credit card companies, they will. All right? So that's why we got $10,000, right? And we also have a car loan, all right? Now we went from hat with eyes. This one looks like a real car, y'all, all right? $400 each month. And what we want to do is we want to, no matter what the principal is, let's say that's $16,000 car, right? 16K. But no matter what the principal is, we know that there's interest getting charged on top of that. And with that $400 each month, this is almost how it looks. Okay? Watch this. How many of you know with that minimum payment that they put down in the paperwork, more is going to them than to the car? At least at first. Does it? It's time to go ahead and make sure that the principal is paid down, as well as paying that minimum monthly payment, okay? And how are we going to do that? We're going to do it by our credit line. We're doing this is called the chunking principle. When you do the chunking principle, you actually fast forward in time. You actually collapse time, meaning you jump years ahead depending on your principal, your chunking principal method, okay? Whether it's 5,000, whether it's 6,000, 7,000, even 10,000, you can jump ahead on the timeline on your loan, meaning you're at that point in the future, maybe 5 years in the future, right? of paying that particular loan off, right? And that's why we had to come out with a system that you can utilize. And that system says, you know what? We can pay this home, this auto loan, this student loan, this credit card. We can pay all of this off in as little as 5 to 10 years. This is what you need to do. And it actually has an action plan to where you don't even have to pay the $5,000. No, you pay how the system shows you how to pay so that you actually have a more cash flow. It's beautiful. It'll tell you what day to pay it and how much. So let's say on one day, it'll be like, yeah, pay that $400 each month. And then on a certain day, it'll be like, you know what? You got enough in your checking or your credit line to go ahead and pay $1,000 this month. And what does that mean? When it goes above the $400 each month in this example, that means we're putting that $1,000 to the principal, right? And we're paying it down. We're not only paying the car loan off, we're not only paying our cards off, we're not only paying the student loan off, we're not only paying all these other loans off, we're paying the mortgage off, all of it in as little as 5 to 10 years, because we finally have a system that says, you know what? You don't got to do it like that. Let's do it like this instead. And it's a GPS for your money. It really is. And look, it uses this system. It's called automated velocity banking. It tells you on each day, right? Now, if you're just starting out, look, this is how it looks. Look at the amortization table on your loans. Look at and talk to the finance section in the car dealership. Notice how the principal and interest is divided up. That's how they make money, folks, right? And after all, you came into them. And so, of course, they're going to have that interest all up front and perhaps throughout the loan. It all depends on your situation. But we have a way of getting rid of it. And that is using the line of credit to attack this principal. Because the bigger the principal, the bigger the interest. But the good news is, the smaller the principal, the smaller the interest. I know you got a lot of value out of that. Listen, like, share, and subscribe all over the world. We are going to come back with another video. God bless you, and you have a great night.